In today's video, we're going to showcase a sixplex conversion project that a client of ours purchased back in February of this year. This is a property that will require $500,000 in a renovation budget. And once it's done, it'll be able to create $11,800 per month in rental income. This property is actually going to be featured on our next Welland investment tour that's coming up in October the 15th. And here's a quick promo about the tour if you're interested in taking a look.
Hey guys, Koukun here. We are at a investment property in the city of Welland and we just completed our investment tour. So these investment tours, we take out some of our new clients to check out a few different projects that are either currently under renovation or complete, just to get an idea of the before and afters. We typically go through the numbers on a project like this, sort of purchase price, after repair value, go into the rental numbers if it's already been rented. So if you're interested, click the link below.
All right, so the link is in the comments below if you are interested in joining, and it is a free investment tour. All right, so this is the property. It is a fourplex at the time of purchase. This property was listed for $1.2 million, and it had been sitting on the market for up to 155 days before our investor closed on this purchase. So our investor put it under contract, I believe, some point in January. We got a 30-day conditional period, even given all of the hype that was in the market back then. And he had to pay pretty much the asking. The seller was not willing to budge whatsoever. So we got it, I think, for $5,000 under the asking price. And that was a very high price for a fourplex at that time. So at the time of the purchase, it looks like this, as you can see in the photos, it is a 4 townhouse style fourplex. So it's pretty much a square building with each corner being a 2-story townhouse unit with a basement for each unit. So each unit has its own separate hydro, separate gas, right? So these are pretty much townhouse style units, and there's a laneway up the side with plenty of parking in the back. This parking ended up being very important in order to do this conversion project. So yeah, like I mentioned, 154 days on the market, built in the 70s, so very solid building. Each unit is about 1,100 square feet, not counting the basement. And as of the purchase, each unit had a full basement with laundry hookups, 2 steel doors, separate furnace, etc. So why was this property sitting on the market? Obviously, they were asking for a pretty high purchase price even at that time. However, the biggest part was this property was fully tenant occupied, and the tenants were paying $936, $779, $936, $936 per month for a 3-bedroom townhouse unit. And the expenses were still pretty significant. The property tax, water, insurance, snow plowing, grass cutting. So again, it does cost money to operate a building like this. And with the existing rents, it was nowhere close to being a profitable investment property. Here is where it's interesting. Our client and my team member Ryan, when he found this property and dug a little bit into it, discovered something very curious. I'm not sure if it will show here, but this particular property has a very unique zoning. So it only says residential here, so it doesn't actually give us much details. But when my team member looked at this property, he discovered that the zoning was a more higher density zoning. It allowed for both commercial and residential uses. It is sort of one street off of the main street, and as a result, the zoning allowed quite a few uses, one of which was a multifamily use, which is unique for this type of property. Usually, this type of property is built in an RL2 zoning, which allows up to 4 units, but only 4 units. That is the max. This zoning, however, allowed much more. So when they toured the property, they were able to get a long conditional period, again, like I mentioned, because the tenants were paying below market rent and the asking price was very high. They were able to tour the property with our friends at Jordan Station Design Co. So our architects were able to take a look at the property as well. And what they discovered is that they were able to create 2 basement apartments in the basement of this property. So already it's a 2-story townhouse style property. There's 4 townhouses, except that the basements were either finished or they were just unfinished storage rooms. What they were able to do is they figured out with the zoning, with the existing parking that was available, they would be able to create 2 newly created legal basement apartments, of which each would have 2 bedrooms, 1 bathroom, and will be, very spacious basement apartments. Pretty much the same space as the townhouse above it, because as you can see this cross here. Each square is the equivalent of 1 floor of the townhouse. So each basement takes up 2 basements of the previous townhouses. So close to, I think, 1,100 square feet of living space, less the furnace room, mechanical room. So still probably about 1,000 square feet of living space. So these are going to be very spacious, very nicely done basement apartments. This is, I think at the bottom, you can see the building. And you can see based on these colors, each color represents a unit. So yellow main floor, yellow second floor, same with all 4 of these basically, plus the 2 basement apartments. You can see about 882 square feet of living space, less the furnace space. All right, how does all of this work out in terms of the numbers? Because our client had to pay, like I mentioned, a premium price. This was a time when interest rates were 2.5%, and the market was incredibly crazy. So he was able to purchase it pretty much at the asking. At the time of purchase, put a 20% down payment, land transfer tax, legal fees. He needed to budget close to $500,000 in terms of renovation budget. Now, this is a little bit more than what it needs to be because he is completely redoing each of the townhouse units. He's adding a second washroom to each of the townhouse. So each of those units are going to be 3-bedroom, 2-bathroom units, plus the required renovations and the development fees and everything that goes into creating 2 additional units in this multifamily property. So all in all, he's going to be in it for $1.7 million. Not chump change. This is a significant investment. Once he's done, he's planning on going with Desjardins, which allows you to get residential financing on a multifamily property. He can get commercial financing on this property as well, but they will charge commercial interest rates, which are typically higher than residential interest rates. Potentially get a higher value. Again, once the project is done, he'll have to weigh his options. But based on the current variable rate with a residential lender, going up to 80% of the value of the property, he will have to leave about $350,000 in equity in the deal. So he'll take out about half of his initial investment. And this property, what we estimate is he'll be able to get about $2,100 per 3-bedroom, 2-bath townhouse, and about $1,600 per each 2-bedroom basement apartment, of which these 2 units are considered newly created. So those will not have rent controls moving into the future. So he'll have 2 units that each year he can increase based on the market. And he now has 4 vacant units that he'll be able to set the market rate. This brings the question, how was he able to get it vacant? Based on this scope of renovation, he needs to renovate and demolish the existing units, at least the basements of the existing units. So because of this, he would have been able to apply for an N13, which is the notice of eviction in order to renovate or demolish the unit. However, he basically, even though that was his option, based on our discussions with him and what we thought was the most pragmatic and also fair way to approach it, he approached each of the 4 tenants, explained to them this was going to be the plan. The units were no longer going to be the same as they were before, so they would have to leave and they wouldn't have the right to come back per se, because he wasn't doing a cosmetic renovation. He was changing the layout of the building. That being said, he was willing to offer them a compensation. I think in total, he offered them somewhere in the range of $10,000 between the 4 units. So he offered them compensation to leave at their own pace, giving them time to find another unit and giving them some money to sort of offset some of their moving costs. Again, it's not something that, it's not a a comfortable experience, so to speak, forcing people to move out of their units. But again, in some ways, he is adding supply to the rental housing stock by creating these 2 basement apartments. So net, Welland is going to have 6 rental units versus 4. The morality of it, I'll leave it to you to judge. But from an investment perspective, he was able to do this legally. He was able to compensate the tenants to move out on their own accord. And in terms of the financials, here's how it works out. Here's the total rent, the mortgage payment. This is with the current mortgage rates at 5%. Again, when he bought this, we didn't know mortgage rates were going to be 5%. The going rate at that time was 2.5%. So even with today's 5% interest rates and a 25-year amortization, because multifamily properties don't necessarily always have 30-year amortizations, we need to put a 25-year amortization here, which increases the mortgage payment. Property taxes, we use the existing amount. This may go up since the use is being converted to commercial, but we'll leave it for now. Insurance, we're estimating at $400, water at $500, and snow and grass removal about $100 a month. In total, he's going to have a net cash flow of close to $2,000 per month. So keep in mind, $2,000 a month of cash flow with a 25-year amortization. And that 25-year amortization really shows up in the profit because the mortgage is being paid down significantly. After 5 years, about $150,000 of pay down, and after 10 years, $350,000 of mortgage pay down. And net, he's going to leave about $350,000 equity. So this isn't a burr. He's not pulling everything out. He's leaving money in the deal. However, his return on investment after 5 years, we're estimating about a 22% compounded return. And after 10 years, about a 17% compounded return. This is with a 5% appreciation on an annual basis from his new value of the property once it is a fully done sixplex. Hope you found this video helpful. If you're interested in checking out this property, make sure to sign up for our Welland investment tour in the link in the comments below. This time we will not be filming our video guy. Sam was not able to make it. So if you don't come to the tour in person, you won't be able to see this property because we won't have a video of it like we've done in our previous tours. So make sure you sign up in the link below to come check it out. And if you have any questions on this project or this strategy or anything to do with real estate investing, feel free to comment in the comments below. And until next time, all the best.